Private equity vehicles have certainly not been adopted by mainstream investors as yet, but with the large investment houses like Old Mutual making more of these investment products available in a retail format, investors now have the chance to gain exposure for relatively small amounts of money. Kevin French from Old Mutual Private Equity joins us from Cape Town to share how the private equity fund of funds he runs have been doing.
Kevin, great to have you on the show here. We obviously just wanted to, for the benefit of our viewers, get a little bit of intro and insight around how these fund of funds works that you operate. Obviously, you've got 3 of these funds in operation at the moment, and you're going to be launching the 4th one. So just give us a bit of insight as to the types of amounts investors must commit, and then the investment horizons and some of the risks that they need to be aware of before they get involved with the fund of funds in private equity.
Thanks, Warren. I think one of the things that most people, if they know about private equity, know is that private equity has traditionally been seen for only the large institutional type investors who typically can write out a check for 100 million rand or more. In 2006, Old Mutual, we launched our first, what we called our multi-manager private equity fund. And we wanted to try and attract retail investors, and we did that by creating a fund of funds, and where the minimum investment amounts were only 100,000 rand, and we found that was quite a good way of getting or providing exposure to the retail investor. It is usually your more astute investors who understand that private equity is a long-term investment. So typically these funds would have a 10-year time horizon for the investor to be exposed to them.
Kevin, we also wanted to just get a bit of insight there. I mean, many of our audience will be familiar with the fact that benchmarks in the public markets, like the All Share Index, et cetera, are used to compare funds against. So what do you aim to do with these funds from a return perspective and the benchmark you use in the private equity space?
The benchmark we use is typically a more of an absolute return one. So we're aiming to outperform inflation or CPI by, depending on the age of the fund, but around 8% over the long term. And while if one does compare private equity to the listed market, because that's usually the retail investor's alternative, we've seen in South Africa that private equity has tended to, on average, outperform the listed market by, depending on time frames again, but over the longer term, around 5 or 6% outperformance of the listed space.
On the performance side, is that a widely acknowledged stat that private equity assets will tend to outperform the traditional equity market?
One has to, I mean, with statistics, one always has to be careful, I guess. But if we have a look at the markets that have been around for a long time, so in the States, you can look at private equity statistics going back over 30 years. And typically there you've seen the average private equity fund outperforming the listed market by just over 6%. In South Africa, our market is a little bit younger, so we do have 10-year numbers currently in the surveys. And as I said, those vary. I think up to the end of December, they were around 2-3% ahead of the listed market. But over other periods of time, we've seen those numbers be in excess of 6%.
What about the risk side of the equation? With the elevated reward potential, are we not seeing additional risk coming into these investments?
I think, there's many different ways. Everyone would tell you that there's different ways you can measure your risk. And one of them is volatility, which is not always seen as the most appropriate way to compare risk or to measure risk. Private equity tends to be less volatile than listed equity. So in that sense, it's slightly less risky. But one of the areas that we focus on in private equity is trying to avoid loss of capital or permanent deterioration of capital. And we believe that a private equity manager, because they're effectively an owner of a company, is better placed to address some of those risks. I'll give you an example. If we buy a company and something goes wrong in that business, or there's challenges in that business, our option is not just to sell it, as would be the case in the listed space, but actually knuckle down with management and find a solution to the problems of that business. And for that reason, we would argue that there are the risks in private equity are mitigated more than you would have in the listed space. But private equity definitely is a long-term investment. So investors who have a shorter time horizon than for example, 7 to 10 years, private equity is probably not the vehicle for them.
Kevin, you raised an interesting point there. Obviously, with being a multi-manager or a fund-of-fund manager, you are selecting these private equity managers to run portions or baskets of your capital. And I see, just looking at the Old Mutual Private Equity Fund 2, you used fund managers like Brait, Ethos, Lareco, Matia, and obviously Old Mutual in-house private equity funds. So I wanted to ask you, just to what extent do you evaluate the managers, both from the perspective of their ability to allocate capital and find good investments for the money, as well as their ability to manage those investments going forward? Does that feature in your thinking to a great degree?
Very much so. Typically, when we start a fund, we're usually buying into a new fund. If we'll talk about our newest fund a little bit later, I think. But for example, one of the managers we've allocated capital to there is Ethos, who have just launched their latest fund now. But even though we're a multi-manager, this isn't like typical multi-management where perhaps you would invest in a manager today and a couple of years down the road you might want to swap that manager for another one. In private equity, because of its long-term nature and the characteristics of the asset class, we have to decide essentially upfront whether we are happy for that manager to manage our clients' money or not. And so it's very much we're taking a call on the manager being a good manager for the duration of the fund, and that they will be a good allocator of capital and able to add value to the businesses that they invest in.
Just a moment ago, we were chatting private equity with Warren from KPMG, and he was saying that the bias firmly from an investment perspective right now is in the infrastructure space, followed closely by the retail consumer story. Are you seeing those similar trends?
Yes, we are. The decisions really are up to the managers of the different funds that we would invest in, but we ourselves are also obviously in managers and doing direct investments as well. But we've seen over the last couple of years, and there still seems to be opportunities there, particularly if you think of the retail space where you have an emerging middle class coming through both in South Africa and also up into Africa, and the knock-on effects that has for retail and businesses servicing that demographic.
Kevin, I just wanted to get a feel. We wanted to talk about some of the exposure that your funds give investors that's a little bit different from what you can get access to in a public market like the JSE, for instance. But before we get there, I just wanted to get a feel for how the fees work in private equity. What fees should investors be, prepared to pay to get access to these vehicles? And if you could just try and explain that with reference to something like the total expense ratio, which many investors in unit trust funds are familiar with. Okay.
Private equity is often seen as a very expensive asset class, and people would suggest we'll avoid it because it's expensive. It is a more expensive asset class, but typically the main reason for that is that your base fees are paid to ensure, or they're paid rather on a small amount of capital in a relative sense. To give you an idea, one of our direct funds that we're about to, or that we're busy raising or making investments into, will only be probably about 3.5 billion rand in size. If you compare that to some of the unit trusts, some of those unit trusts are 10 times that size if one thinks in the general equity space. And because of that, your base fees do have to be slightly higher, and typically what you're looking at is a 2% base fee but that would be on the cost of the investments made. I just need to explain that just to clarify that. So if we raise R1 billion in a fund, the 2% charge is not charged on that R1 billion as it grows. It's only charged on the R1 billion throughout the life of the fund. So in other words, the cost price. And then there is a performance fee charged in private equity as well, and that varies from manager to manager, but a rule of thumb would be typically that you would charge a performance fee of around of 2%, of 20% of performance above a preferred return, and usually that preferred return is 10%. The importance of preferred return is that the performance fee is only paid if that preferred return is received by the underlying investors.
So Kevin, just to get that right, I mean, you as the multi-manager or the fund manager of clients' funds would negotiate these fees on behalf of your vehicle in respect of the third-party investment managers that you'd be using. So the Lareco Mateas and the Actis, you'd go to them and negotiate fees for inclusion of your funds, and then obviously you present that fee to your investors as one fee. They don't have to worry about figuring out whether the fee charged there and the fee there is all added together. You identify that preferred return per the fund of fund.
That's correct. So we would negotiate with all the underlying managers, and the return that the client sees at the end of the day is net of all those fees. To give you maybe it's important to note that the returns that I was referring to earlier that we've seen in the industry above the all-share index, for example, all those comparisons are made net of all these fees. So, when we say that over time, let's say there's an expectation that private equity could outperform the listed market by around 5% on average, that's net of any fees, both a performance fee and base fee that I spoke of earlier.
Kevin, let's just touch on the fourth fund and the rationale behind it. Why should the retail investor out there get excited about it?
I think there's probably three key features that I'd like to highlight around this fund. As you mentioned earlier, this is our fourth retail fund or fund of funds that we've launched. The first one is obviously that a retail investor can get exposure to this. It's the minimum investment size is 100,000 Rand. The second one is that there is a level of gearing within the product, and all that the main reason that is there for is to ensure that you don't put money into a product and then it lies in cash for a number of months while the underlying managers try to find exposure or underlying companies to invest in. So on day one, most of the clients, if the client puts in R1 million, most of that investment would be exposed to private equity assets on day one, because part of the portfolio is buying into existing private equity assets. Around just over a third of the portfolio will be invested into existing private equity assets. And then the last feature is quite a unique one that we've seen both in South Africa and globally, is that we provide our investors with a liquidity option. Typically in private equity, you'd invest on day one and you're locked in until 10 years hence when the product matures. With this liquidity option that we've provided for clients, should they, during the term of the fund, for some reason want to get their capital out again, they have the option to call on Old Mutual to actually pay out the capital that they put in. So if they put in R1 million and after 5 years that million is now 2 million, but they want to take out R1 million, they're able to do that. There is a fee to do that, but it's only charged if you exercise that option.